Hi, the name of the show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker, retired and rehired, and proud of it. Basically, the show is live to tape. For me, it's September 19th. For you, it's probably Sunday, September 21, or Tuesday, September 23. And basically, the way this show works is I am live. I'm doing my show. I only know what happened up to Friday, and I don't know much of that. And consequently, anything that I say will probably be completely obsolete, especially considering the subject of the day, by the time you watch it. But that's the way this show works, and that's one of the charms of it. The other charm is what I call it's charming unprofessionalism. Basically, I have a desk over here, and on this desk, I have, in a nutshell, my own anchor desk. So I'm not only my own anchor, but I'm my own engineer. So I can basically spin the world. I can switch from camera to camera. I can disappear myself and reappear myself. But the catch to everything is, if I really make a mistake, and I have been doing it a lot lately, you are going to see it on Sunday or Tuesday. Nothing is perfect, and I'm not a very good engineer, and kind of proud of the basic unprofessionalism and amateurishness of this show. Basically, I'm going to talk about one major thing, and that is the financial apocalypse that started this week and didn't end and didn't get completed, and basically what it was, how it happened, what brought us here, what the candidates are saying about it, and I only have some information that's not complete, and how I feel they're doing about it. Naturally, global financial jeopardy has occurred during a major presidential campaign in the what I contend is the most powerful country in the world, the United States. China's catching up, but hasn't caught up yet. And Russia, while extremely aggressive, and we've talked about that quite a bit, about the new Cold War, isn't even a candidate for global superpower, despite their pretensions of grandeur. So America's still it. We still got a $14 trillion economy, matching Europe, matching all of Europe put together. And we still have the ability to screw up and knock the entire world financial system into depression. And when I say depression, I'm talking about the Great Depression, and we were very, very close to the first steps of that this week. What happened? Well, what happened was, after bailing out Fannie Mae and Freddie Mac, the giant federally supported and now basically owned by the federal government mortgage giants, they're the people that guarantee half of all of the mortgages in the entire United States. And also, unfortunately, the dumb bunnies that bought the mortgage-driven derivatives that have really done their best to try to collapse our economy. As a result, we have all kinds of problems. And we are in the midst of a financial crisis. Why? Because the banks bought derivatives supposedly backed by mortgages, but they weren't backed by anything. The entire mortgage derivative market, in my opinion, was a fraud. And the reason it was a fraud is because an issuer of these CDOs, these mortgage-backed derivatives, Goldman Sachs, Barclays, there were a bunch of them, a bunch of guilty parties. And basically what they would do is they would buy a pool of mortgages. They would expand their pool of mortgages. They would buy mortgages whether they were good or bad. But when they issued the derivatives, the owner of the derivatives did not own the mortgage itself. What they owned was a claim on the cash flow, not even from interest payments paid against the mortgages, but against swaps. And what are swaps? Swaps, in a nutshell, are little bitty insurance policies where I say, I have a mortgage over here. I will give the swap dealer $100 to guarantee the value of the mortgage if the default rate is at 0.8%. And another one if the default rate is at 0.9%. And another one if the default rate is at 1%, and so on and so forth. There's a trigger point at which the entire derivative becomes worthless. Does it mean that the mortgages in the mortgage pool are worthless? No, they're still worth something. Basically, even at a 4% default rate, which I think is the worst estimate of the total mortgages that we have. Of course, subprime mortgages are more like 20%. 96% of the mortgages are good. And the fact of the matter is all the mortgages in the entire nation are worth about $13 trillion, less than our national product for a year, which means that all of the property that it's mortgaged against about 15 or 16 trillion dollars, and it's worth that. Might be the price of properties might go down a little bit, but basically there's a lot of property over here. There's a lot of property that's in farms. There's a lot of factories that are going on. There's a lot of office buildings that are full of offices, and there's a lot of homes that are being lived in that have people who still have jobs and are still able to pay something. So and there's still value out there. So basically, the real estate market will come back, and when it does, the mortgages will be worth something. The question is, these derivatives that basically became worthless when the default rates went to a trigger point, whether they are worth anything at all. And basically, one way to determine that is to try to sell it. Right now, they're unsellable. However, in my opinion, I think that the government, when they buy the derivatives, need to go back to the issuers and to liquidate the mortgage pools that the issuers have given and basically seize them, and then link the value of the mortgage derivatives to individual and specific mortgages or mortgage pools. Can that be done? Yeah, sure, it can be done. Will that be done? We'll see. Basically, what happened was there's been a series of runs, and I have to admit they are runs against various financial institutions by basically sleazy investors, sleazy hedge fund owners who are thieves and sleazoids who what they do is they go in, they are short selling. Now, short selling is a legal thing, but there's a limit to it. And basically what short selling is I think that AIG Mortgage Company or Lehman Brothers is going to go down. I think that their stock is going to go down. So what I'm going to do is I'm going to borrow shares, and then I will sell those shares that I borrowed on the hope that when they go down, I'll buy them back, and then I will make a profit. What's going on is the people that are raiding the financial companies in the country, trying to collapse the financial system in the country and the world, are basically not borrowing the shares. They are selling shares they don't own, and that is fraud. Way back in the 1800s, a guy named Fisk. Fisk and Gould were speculators that cheated investors out of what would today be worth billions, but in those days millions of dollars. They owned the New York Railroad, and he said, he who sells what isn't his'n must buy it back or go to prison. There's some cases in naked short selling, not in these particular items, where the naked short sellers sold more shares than exist. And there's about 20 cases of it. There's a guy who I guess was burned by the naked short sellers. He's another hedge fund owner, and he basically has gone after them, and he's has put together on a website a list of 20 cases with specific days and specific amounts of shares where more shares were sold than exist, which is a definite proof by default that fraud had occurred. These people need to go to jail. This is not normal. This is not doing business. This is not capitalism. This is fraud. And in this particular case, in the last couple of months, this has been a run on our entire financial system, and it's forced the Federal Reserve to go and bail out institutions which had a lot of these new markets themselves probably having defrauded a lot of people. But if they went down, they would bring banks down, not just in America, but in Europe and in Asia, throughout the world, and bring down the financial system in exactly the same way as had occurred in the Great Depression, 1930. 1930, the Bank of the United States, there was a run on the bank. The people that ran the clearinghouses would not provide liquidity to that particular bank. And then a bank in Austria collapsed, a bank in France collapsed, a bank in Britain collapsed. And next thing you know, there was collapses throughout the entire financial system. People were running to the banks and pulling out all their cash out of the bank, collapsing bank after bank. And the result was the Great Depression in every industrialized country in the world. Basically, the Federal Reserve, and I really appreciate what Ben Bernanke, he's our Federal Reserve Chairman, has done. He's avoided shots against our financial system, a number of them. First, of course, was the bailout of Bear Stearns. And the bailout of Bear Stearns meant that the entire currency swap market, which is worth more than all the value of all the goods in the entire world, would have collapsed, collapsing currency trades throughout the entire world and making them impossible. They were bailed out. Then there was a situation just this week where they decided that there was a point. Well, Fannie Mae and Freddie Mac were bailed out. Basically, if they had defaulted, that would have defaulted basically half of all of the mortgages in the United States. And not only do our mortgages and mortgage derivatives in the United States owned by our own banks, which would have collapsed bank after bank after bank, but also would have collapsed banks all over the UK, all over Europe, all over Asia, and basically taken down again the entire financial system. Is that a danger? That is a terrible danger, and that is a horrible thing. And we have to hope that that would not occur. So what was next? Well, they decided to draw a line in the sand. A lot of the politicians, I wish they had kept their mouths shut, criticized that you're bailing out the big boys, and all the little people that are having foreclosed houses throughout the country are not being bailed out. Even though there was a plan to bail them out through refinancing through Fannie Mae and Freddie Mac, so which are now government owned. So what happened then? Well, they decided that Lehman Brothers, the fourth largest investment bank in the country, they were going down. There was, again, a short selling rate against their stock, which ran their stock down to 10% of its value. Eventually, it would have been 2%. I don't know how far it would have gone. And they said, no, we're not going to bail it out. We expect a bank to come in there, buy these folks out. Did it happen? No, it didn't. And consequently, we had a drop of 500 points in the Dow, of 4 or 5% in the S&P, and every stock market practically in the world. Stock markets all over Europe went down, Asia, Japan, South Korea. Everybody was hooked into this. And in the midst of that day, a major hedge fund, which was apparently owed money by Lehman Brothers, collapsed as well. Meanwhile, it looked like the short sellers were going to bring down Merrill Lynch. Merrill Lynch, not only is Merrill Lynch, it's a gigantic financial services company. It's an issuer of these lousy debts. Some of the people that were the thieves that caused the situation work for them or have been fired by them in the course of time. They're also owners of 49% of BlackRock, one of the largest mutual fund companies in the country. They're one of the biggest stockbrokers in the country. Millions and millions of investors have their brokerage accounts with them. Basically, another one too big to fail, and they were bought out by Bank of America. So it really looked like everything was going down. And the worst threat was an insurance company, and everybody would think, well, what does an insurance company have to do with it? Well, it was half an insurance company, but the other half insured the bad debt in these mortgage-backed derivatives and CDOs that are the problem. So if they had gone under, they would have all the mortgage insurance against all of these CDOs and all of these derivatives throughout the world would have no longer been insured, and then something happened, and that would have triggered something right then and there. They would have collapsed one by one by one by one. And again, it could have collapsed the entire financial system, causing what can only be described as a financial calamity. So did that happen? No. The Fed had to come up with $80 billion, and basically what they did is they loaned the company the $80 billion, but what they really had done is they bought and control now 80% of AIG. So now the federal government and the taxpayer are the owners of a major insurance company that's also a financial derivatives player of the first order. I expected the next day, because the day that happened, the market went up. It gone down 500 points. The next day it went up about 140. It looked like things were stabilizing. And then they bailed out AIG. So the Fed and the Treasury Department basically backed up on their words, saying, no, we're not going to bail out the bigwigs. They did bail out the bigwigs. And what happened next? Well, what happened next was a free fall. And there was virtually a free fall the following day. Another 500 points on the Dow, about 40 or 50 points, depending on the time of day, against the S&P 500. Markets all over the world, not just here, were dropping 5%, 6%, 4%, 7%. These are big drops, especially twice in a row. So what happened was there was a summit. They brought in the Democrats in the House, especially Nancy Pelosi. I believe that Senator Chris Dodd, who's a financial wizard on the Democratic side, they brought in Boehner, who's the head of the Republicans in the House, and some of the leading Republicans, Harry Reid and so on and so forth. And Harry Reid's a Democrat, leading Republicans in the Senate. Brought them all together and basically said, look, we have to get to the root cause of this problem. And we are going to do it by creating what had occurred in the late 1980s and early 90s when the S&Ls collapsed. And basically, the S&Ls collapsed one after another based on bad mortgages, on bad, very, very large commercial and housing developments, which were ridiculous, bought at 5 or 10 times the value. And then basically the builders owned the S&Ls that were financing their builds, so that there was no check and balance in the system. It got so bad that the government had to come in. At the time, the organization that was created to take over all these bad properties, which was called the Resolution Trust Corporation, RTC, that was worth $500 billion. Well, they ended up only losing $100 billion because they held it for a few years. The fact that they were doing it stabilized the markets. They saved the S&Ls. They collapsed a few, separated the builders from the S&Ls, basically passed some rules about it. And you notice the S&Ls don't seem to be part of this whole collapse because they've already been through increased regulation. So that basically happened. There was a tremendous improvement in the market, and real estate came back up. In fact, it came back up too much. And we had this boom in the 2000s that was caused by the fact that any speculator could get a mortgage that would be sold by an unscrupulous mortgage broker, and that he knew, the mortgage broker knew, that any bad mortgage, no matter how silly and stupid, would be bought by these issuers of the derivatives who really didn't care. They got the money from the buyer of the derivative up front, and as long as they had a pool of mortgages, they could justify selling more derivatives. So basically, it was a fraud from the beginning to end. Unfortunately, if a fraud gets this big, endangers the entire system, then we just have to bail them out. We can, and we should, after we bail out the system, and we save the system from complete collapse, find out who issued these derivatives, who offered these derivatives, which were not understood by anybody, including themselves, to the rating companies, and who persuaded Moody's and the other rating companies to rate these things at high rates, AAA or AA, and put these out on the market to be bought by banks. And when they went sour, banks don't have any money to loan. The banks do have money to loan, but they're unwilling to loan it. And that's what's causing the liquidity crisis. So basically what they're talking about is taking all these, putting them aside, creating a government department to buy all of these lousy derivatives. And I believe that they need to buy the derivatives, and they need to seize the pools of mortgages from the issuers of the derivatives. If the derivatives were issued by Goldman Sachs or BlackRock or any of these companies, and they bought mortgages to create the pool that supposedly backs the derivatives, but they really don't because they're backed by swaps, then those pools of mortgages have to be seized by this agency in order to back up and to verify that there is some value to the mortgages. Now I'm going to go out, and I don't have a good track on how many minutes I've gone because I didn't get my counter today. But what I'm going to do is I'm going to go over here, and I'm going to bring up my counter. I'm going to disappear myself. I believe you can still hear my voice. But basically, this is this week's, even during and after this horrible crisis over here. This is the electoral map. The ironic thing about it is that McCain and Palin, I'm going to try to center this. This is what's so charming. What it's doing is going back and forth. Okay, what I'm going to do. Oh boy, this is a disaster here. Where is the map I'm looking for? Okay. There we go. Okay, this is this week's RCP, which stands for Real Clear Politics. I've been saying Real Complete Politics. And basically, this is the week that McCain lost its lead back to Obama, but this is the red state map, blue state map, and the ironic thing about it is that McCain is still winning on the map. What happened was McCain is leading in the toss-up states of Ohio and Indiana and Nevada, still losing in Colorado, which is one of the red states, and Iowa and New Mexico, which were in the Obama column, now have gone to the lean Obama column. But